Good morning, everyone. We're going to get started here in just a few minutes. I have unmuted your lines, so you can self-mute if you think you're going to have some background noise. If you think you're going to have a quiet environment, I would encourage you to keep your line open, because we're going to have much more interactive exercises during this webinar as opposed to the one we had Tuesday. Everyone that's going to participate needs to make sure that they have a calculator handy. So if you've got your smartphone, you're good to go. We're going to do some exercises where I'm not going to give you guys the answers. I'm going to want you to see if you can arrive at the right answer. Did everyone receive the email version of the PDF that I sent out, materials? Because I did not, or I did attach it here. I just wanted to make sure everyone was able to print that out successfully.
Yes.
Okay. And while we're waiting for the last few participants to join in, did anyone have any questions from Tuesday's webinar that they thought of after the end of the session that they want to go ahead and ask? Okay.
Hey, Jenny, this is Mandy. I'm just testing my microphone.
You're good.
Thank you.
Uh-huh. As you guys are joining in, I'm trying to unmute you, but you can self-mute if you want. Okay. Raise your hand if you were not on Tuesday's session and this is your first Blueprint Housing Solutions webinar that you've had. All right, so we got Kim and Deetra. Okay. I'm going to give you two kind of an abbreviated introduction of who I am, just so you can understand how I train, but everyone else will have to listen to this for the second time. So for the two of you, I've been in the industry for about 20 years. My name is Jenny De Silva, and I've worked for about 14, 15 years. I worked for Southwest Housing Compliance Corporation, which is the contract administrator for Texas and Arkansas. So that entity oversees about 900 project-based Section 8 communities in those two states. And when I worked for the CA, I oversaw the voucher department, and I also oversaw management and occupancy review staff that went out and did the management reviews at the sites. And in 2014, I decided to move from Austin, Texas up to Syracuse, New York, which was a cultural change as well as a climate change for me. But when I worked up in Syracuse, I worked for PMCS, which is a consulting and service bureau entity that services a lot of the Northeast. And that was a great opportunity for me to see this industry from the perspective of the property managers. I went and did recertification interviews. I processed vouchers. I developed policies and procedures for properties. But my passion is really training. And what I like to do is to be able to break down complex regulations and make them manageable and meaningful and applicable to property managers in their everyday activities. So ultimately, I decided I didn't like living in Siberia for 6 months. It was entirely too cold up there, and I missed Mexican food. So I came back down to Austin, Texas in 2016, and I helped Southwest Housing launch what's now Blueprint Housing Solutions, which is a consulting, training, and services organization for the affordable housing owners and agents across the nation. And so I've worked extensively with some of your corporate staff, not only as their CA, but helping provide a training series for you all that I hope helps you in your everyday activities. And I think one of the keys to the trainings is I give you materials that I really want you to be able to use as a standalone cheat sheet or kind of a Cliff Notes version of the handbook, written in plain English. And then I like to use my time on the webinar to show you how to apply these regulations to your everyday recertification tasks. And so I sprinkle in some interactive activities and quizzes that are going to test your understanding. And that's where you guys have to show me that you're on the other line, because when I put these questions out for you, the answers are not going to be in your materials. And if you don't try and see if you understand the concept and answer the question, you're going to be doing yourself a disservice. So at those points in the webinar, I want you to use your calculator, use what we've talked about, and see if you can come up with the right answers. And it's okay if you get them wrong. I'm going to show you how to get them, ultimately, how to arrive at the right answer. But if you don't try and self-test yourself to make sure you've mastered the concept, it's not going to be as easy for you to apply it next week when you're doing a recertification interview. Okay? So throughout this webinar, this is interactive. If you have a question, please ask it, because there's 20 other people on the line that probably at least a few of those might have the exact same question, and you all will benefit from the dialogue that we have during the webinar. You can also post questions to me on the chat feature if you'd like, or you can type them into the questions box, and I will try and keep an eye out for those so that you can take a look at those. I can take a look at those and try and answer those as we go through the session. I don't want you to wait until the end. I want you to ask your questions as they present themselves while we're talking about that issue in context. Okay? All right, so let's go ahead and get started. Today's session, we're going to talk about assets. And generally speaking, managers don't like assets because we don't deal with them as frequently as we do income and expenses. And some of the terminology and some of the financial documents that we get from financial institutions might be foreign to us. And they're just kind of scary to deal with because we don't see them as frequently. And what I'm going to do is make sure that we all understand what HUD considers an asset, because what HUD considers an asset and what someone walking down the street considers an asset are two definitions. And then we're going to talk about different types of assets. And a lot of people get this terminology confused. There's two types of assets. There's current assets and divested or disposed of assets. So we're going to differentiate those two categories. Then once we've established what assets are, we're going to learn how to calculate the cash value. And that is absolutely a fundamental step that if you do not master how to calculate the cash value, 9 times out of 10, you're going to screw up calculating the imputed income, which is the third part of the webinar. When we talk about what type of income do assets generate? Well, they can generate actual income because they have like interest rates or something like that. Or they can have what we call imputed income, where we incorporate what's called a passbook rate in. And so I just, in that 2 minutes, I threw a bunch of terminology in that at the end of this webinar is going to make more sense to you. We're going to end the session with an activity where I want to see what you pick up on in terms of assets when you're going through an interview process with a resident, whether that's at a move-in or at an interim or at an annual recertification. I want to see what other types of issues you guys are identifying in the interview process. Okay. Following along either on your materials or on the slide, we're on page 1 of the materials right now. And first thing that we want to define is what is an asset in the world of HUD affordable housing. Well, the ones that we're accustomed and are less intimidated by, or is if your residents actually have cash in their wallet or cash hidden under their mattress or in a jar, if they have a checking account, if they have a savings account, and a new element or a new type of asset that's more prominent now than it was 10 years ago are what we call EBT cards. And these are reloadable debit cards that are issued by a variety of different agencies that pay out monthly benefits. Because most of you on the line have either an elderly or disabled population, you are probably seeing a lot of these EBT cards pretty frequently because one example of that is the Direct Express debit card. Well, we're going to actually talk about some of the other types of EBT cards that you're going to encounter as well. The other half of the types of assets are ones that we don't necessarily encounter as frequently as checking and savings accounts. And this can include things like CDs, stocks and bonds, treasury bills, mutual funds, money market accounts, maybe retirement accounts. If someone actually owns real estate, that is an investment, even if they're not living in that real estate. And then there's particular types of life insurance policies that are called whole or universal that are considered assets, as well as trusts. Now, these are ones, some of us, you know, myself included, when I started working in this industry, I couldn't tell you what a treasury bill was or what the difference between a CD or a money market account is. And you don't have to understand the characteristics of this of these assets as much as you have to continuously apply the same rule when you're doing your calculation. So don't fret if you don't have a lot of experience or exposure to these types of assets. That's not going to hamper your ability to perform the calculations to arrive at cash value. But let's spend just a little bit of time talking about why it is so important that assets have to be identified. Well, it's not so much the value or how much is in the asset account that plays a role in determining a resident's rent, as we need to ultimately find out how much income that asset is generating. Because it's the income that's generated by the asset that plays a role in rental calculations. And there's a pretty significant misunderstanding with individuals that don't work in this industry. And that is, they assume that if somebody has a lot in the bank, maybe they have $400,000 in their checking account, a layman on the street might think, well, that person doesn't qualify for subsidized housing because they've got a whole bunch of money in their checking account. And in reality, that is not the case in several areas of the country. And for those of you that are in California or up in the East Coast, maybe, that is quite common to have an elderly property with residents that have significant assets that really aren't generating that much income, and they can still qualify to live in Section 8 or affordable housing. So we can't focus too much on the balance that's in the account. We really ultimately need to arrive at the income that's being generated, because that's the element that plays a role in your calculation. Okay, so when we're talking about different types of assets, you're going to hear me reiterate throughout the webinar that there is what's called current assets, which are assets that we physically possess right now, that we can, if we chose to, convert it into cash in hand. So it's important when you're looking at assets that you don't necessarily consider the balance value or what's in the account right now. What you ultimately want to arrive at is what we call the cash value. And that is, if you were to take that asset, whether it is a house that you were to sell or an account in a financial institution that you were going to close out the account, you want to say, what is it worth after I would have to pay costs associated with converting it to cash in my hand? So you think about it, if you have a CD account and it's sitting at a financial institution and it hasn't matured, but you want to go ahead and close the account out and liquidate it. Well, with many of these types of accounts, you're going to pay an early termination penalty, you're going to pay a tax penalty, or there's going to be some type of fee to close that account out before it has fully matured. And those penalties have to be deducted from the value in order for you to arrive at your cash value. So the simple definition is to remember that cash value is the amount of the money that your resident is going to get after they've taken the hit and the penalty and they've paid the fees to convert it to cash in hand, and they're physically walking out of the financial institution with cash in their hand that is then spendable. And the number one error that we see when we're looking at tenant files at any type of property where their resident has assets, it doesn't really matter if it's a senior property or a family property, what we see is the manager gets a statement from the bank for some type of maybe retirement account, and it says what its current market value or its current balance in the account is, and that's the exact figure that they're putting on the 5.9 for cash value. And the mistake that they're making is they're not subtracting those penalties or fees associated with liquidating the account. So that's the number one calculation error that we see in file audits specific to assets. Any questions so far? We're going to get some practice and some exposure doing these calculations in just a minute. But this is a critical step for everyone to understand, because if you don't get your cash values right, your subsequent income calculations are going to be incorrect every single time. So it's a fundamental step to make sure you understand. So let's say we are getting exposed to some of these assets through an interview with a resident that has some asset accounts. There are some specific rules that HUD has established in order for you to arrive at the cash value. So for example, the ones that we're accustomed to seeing are checking accounts and savings accounts. So when a resident brings you verification that they have a checking account, or maybe they just tell you on their paperwork that they have a checking account. The old school verification method often meant that the manager was sending a verification form directly to the bank, and it said, please tell me the average 6-month balance on this resident's account. And sometimes the bank would send that verification back to you with that information. Does that fly with HUD? Yeah, it'll work. It's an acceptable verification, but it's not the ideal, most thorough way of verifying a checking account. What's the better way of verifying a checking account to arrive at an average 6-month balance? What's another method maybe some of you guys use to verify checking accounts?
Using their 6 most current checking account statements?
Yes. And why is it better to get the checking account statements themselves?
I personally like using them because you can see a lot of other things at the same time. Deposits coming in from other areas they may have not reported, and
Bingo.
so forth and so forth. What comes in and what goes out.
Exactly. And really, if we really go down to bare bones, we don't care what they're spending their money on. You know, that's not our business. We care about where they're getting their income. And you're absolutely right. Checking accounts tell you a lot more than just the average 6-month balance. And some residents are going to be really apprehensive about giving you that because they think you're getting in their business. You're prying into their private matters. And sometimes you have to be prepared to tactfully and politely say, you know, verification of your financial circumstances is one of the elements of this program. And for all intents and purposes, your privacy's kind of gone out the window if you're going to be living in subsidized housing. If you want to have complete privacy for your financial situation, you can go and live in a market property. But you know, this is kind of one of the elements and things that you have to kind of live with if you're going to live at a subsidized property. It is better, in my opinion, it is a much better practice to get the full 6 months of consecutive bank statements in order to calculate that checking account average balance. Okay. Now, CA or HUD could not give you a finding if Wells Fargo gave you a single verification form back that was dated, you know, appropriately, and it said this individual's average 6-month balance was this. You know, technically that meets the requirement, but it doesn't tell you as much as what you could glean from looking at the statement. So unlike the checking accounts, savings accounts, you just have to look at the most current statement. You don't calculate an average, and you just go with the current account balance. Okay? Stocks, bonds, treasury bills, mutual funds, and money market accounts, sometimes those are sub categories of assets that are really managed maybe by a single financial management institution that does retirement planning. So it might be, you know, Charles Schwab or TW Price, or you know, those other Bank of America, or these big institutions that will help their members reinvest their money in different investment options. Oftentimes, they will get a statement every month that shows the activity for their account, you know, how much money their investments earned, what they lost, what was put into the account. And in those cases, that's where you really have to be careful and do the math and take the market value, whatever the statement says the current market value for that account is, And then you have to find a way to identify and subtract fees and penalties that would be associated if you were to deplete that account today and walk away with your money. All right. So you have to understand that with those types of assets, you're really taking a snapshot in time. This month is a perfect example of a month where the stock market has gone really high on some days and really low on other days. So in order for you to capture that this is a snapshot in time, you need to make sure that the statements that you're getting have statement dates, and you need to make sure that your date stamping when you receive those to show that they are within the time frame of acceptable verifications when you're doing your research. Someone did pose a question going back a little bit on the bank statements. If you're using bank statements, do you keep all the pages in the file or just the first page? Debbie, I would recommend that you keep all the pages in the file because it'll show the transaction history and specifically deposits that are coming in. You never want to make it unclear to an auditor whether there was something on a page that's not in the file that would have been pertinent. So if you're provided all pages, I would file all pages. Okay. So we're going to get some additional exposure to looking at these statement balances in some other advanced classes that I offer as well. And we might be able to have a little time to look at that at the end of this class. But just know, you don't have to understand every table, chart, or pie graph that they might be illustrating on these statements. They also oftentimes offer a 1-800 number where you can call and say, okay, I need you to tell this to me in plain English. At the top of my statement, it shows the market value as blank, and it's this type of account, and I just need you to tell me what would be the penalty, what would be the percentage rate on the fee that I would lose if I were to convert it to cash. That's what those customer service reps are there for. So, you don't have to be a financial planner in order to calculate the cash value. You might also have another type of account called a CD, or a certificate of deposit. And these are ones that grow in value. They have face value that grows the longer you keep it in the account. And again, if you liquidate that account early, you pay what are called prepayment penalties. And each of these financial institutions should be able to identify in some type of account summary what the prepayment penalty is. Any questions so far? Okay, let's talk a little bit about joint versus single accounts, because this is something that I often see even the most tenured managers not pick up during the interview process. And that is, let's pretend John and Rachel open an account together and they're both named as the account owners on the statement. And that's usually the identification that you've got more than one owner on the account. If both of their names show on the statement for a checking account or a savings account, let's say, that means that both of those individuals have equal access to the funds. They can withdraw from it, they can put money into it, and they have equal access to the money. And when that is the case, you prorate the cash value to each of the owners. Okay, so what that means is if John is the only one living at your property and he has a joint checking account with Rachel, and you can see that when you're looking at the statements, then once you calculate that average 6-month balance, what are you then doing to arrive at the cash value attributed to John? if you're going to prorate it to each member and Rachel does not live at your property, how much of that average 6-month balance are you going to put on your 5/9 for John?
Just 50%?
50%?
Just 50% of it, right? So be cognizant of that, because you might be surprised at how many of your residents you've been counting the full account balance on their assets when really only 50% of it was attributed to them. I often see this as examples in senior properties where adult children of aging parents are on their account. If you are not sure whether they are deemed an owner of the account, you can call the financial institution. But usually, if their name is listed along with their parent's name on the bank statement, they have, check signing authority, they can withdraw the funds, they are co-owner of that account, and you should only be representing 50% of that average 6-month balance on the 5/9. Any questions on joint accounts?
Okay.
Now, if you have a joint account and both members are in the household, I don't think you necessarily have to split it out on the 5/9, 50% for member 1, 50% for member 2. It's really only has a mathematical impact if one of the account owners is not living in your unit. All right. Any questions? Let's see. Norma, did you have a question? I saw your hand was raised. I don't know, maybe you don't have a question anymore. Norma, did you still have a question? Okay. Marianne has asked, does this exclude representative payees? So you may be thinking, Marianne, about maybe someone is disabled and their SSI monthly benefit goes to a representative payee. If you looked at the statement for that representative payee, chances are your resident's name isn't going to be listed on there. It's just going to be the representative payee. So if the resident's name is not listed, then I would say no, that would not be an asset. But that does not mean that that's not considered income for your resident. In those situations, they may not have access to the asset account that it's going into, but the SSI benefit is still considered income for your resident, even if they have a representative payee. It really is going to depend on what the statement looks like. So if in doubt, you can just make sure that you're calling the financial institution if you need to verify that. And then whatever documentation you have for that verification call, you can write that on the statement to substantiate whether you did or did not consider it a joint account. All right, any other questions? Mandy, did you have a question? I got hands going up and down here. You got one?
Yes, I'm sorry.
Go ahead.
So if a resident has 3 of their children on their bank account as a joint account, do you give the resident the 25% and then do you put maybe a clarification in there why you did that?
Assuming the 3 children are not in the unit?
Correct.
I would, because your reviewer might not know the HUD rules themselves. Yeah, so make it abundantly clear. It's in the reference. It's in paragraph 5-7 of the handbook that you prorate joint accounts. So if you want to make it abundantly clear to an auditor that may or may not know the HUD regulation, you can absolutely clarify that. All right.
Okay, and then one more question. You might have went over this, but I had to step out for a few minutes. For the Direct Express card, am I correct that they consider that a savings, so we just need the current balance?
Yes, and I'm going to go over that in a little bit more detail in a couple of slides, but long and short is yes, that's the correct answer.
Okay, perfect. Thank you.
Okay. Brittany, did you still have a question?
Yeah, I did.
Go ahead.
So I've seen residents have their kids on the account so that if they were just to pass away or something, the kids could have access to it, but they don't count and it's like solely for that purpose. Would you just do a clarification or would you still divide it?
I wouldn't take just that statement from the resident. I would call the financial institution and specifically ask, does that second person listed on the statement have full access and withdrawal rights? If they say yes, it is a joint account.
Okay.
Even if there's a unique arrangement or understanding amongst the family members as to when that access would be appropriate, if they by definition can do and have the same rights to the money as the primary account holder, then it is a joint account, and I would split it. Yes.
Okay. Thank you.
Okay. All right. Let me make sure I've got all the other hands written. Okay, I don't see any more hands then. Okay, good. All right, so that's joint and single accounts. And I've given that reference to you if anybody ever challenges you on doing a proration on a joint account. It's that 57D1. That's in your handout as well. Okay, so let's talk a little bit about these debit cards. The most common one that you're going to see absolutely is that Direct Express debit card. So those are relatively new in the arena of affordable housing. Most of you know that Social Security was wanting to save some money and stop mailing out the paper checks. Now, a resident, if they refuse to go the Direct Express route, they could have continue to get paper checks, but if they didn't refuse that, then they automatically defaulted to getting a Direct Express card. And so those will be debit cards that will be loaded monthly for Social Security and SSI benefits. But there's actually more and more federal agencies that are loading monthly benefits on these same or these same EBT cards. Unemployment agencies are loading them. Many national retail chains, Macy's, Home Depot, Walmart, these big retail chains have stopped sending out paychecks as well and are loading them on these debit cards. SNAP benefits, which are food stamps, are loaded on them as well, but that's the only type of income that's on this screen that is not considered income in the HUD program. So you might actually have the same EBT card that has TANF benefits and food stamp benefits, and the food stamp benefits can't be pulsed out at an ATM machine, but the TANF value on that card could. And the TANF amount would be considered income. The food stamp allocation would not. But just be aware that those can actually be loaded on the same cards. We're also seeing several attorney general's offices or federal agencies that monitor child support payments, garnishments. Those are coming on these EBT cards as well. And here's the issue that you all have in terms of establishing kind of a procedure and a policy on these EBT cards. HUD has only gone on record to say, this is what we want you to do with Direct Express cards. And they issued this to the industry via the RIP listserv. So I want you all to think, anyone that's on this training that does not get the RIP listserv, that needs to be on a homework assignment for you tonight. It is super easy to Google RIP listserv all you have to do is put in your email address, and then you're on HUD's email subscription for what has ultimately become the only real mechanism they have of pushing out new regulations, new notices, and announcements to the industry. So it's absolutely free, and there's no reason every single person on this call should not be getting the RIP listserv. So subscribe to that tonight if you are not already on that email list. But they came out with this listserv and they said, we want you to treat it as a savings account. And the way we want you to verify it is to either get a current statement from the resident, or you can ask the resident to go to an ATM machine and do a balance inquiry. And that's fast, that's easy, and that's free, but you have to make sure that the receipt from the ATM that the resident gives you is attributed to their card. And you can't gather all of that by looking at the ATM receipt. The ATM receipt doesn't show the resident's name, and it only shows a portion of the account number. So you have to document on that ATM receipt that you in some way reconciled that receipt to your resident's ATM card or your resident's debit card. Now, HUD does not suggest that you make a copy of the Direct Express debit card and put it in the file, because then you have someone's full credit card account, and that's a little dangerous for you as an owner to have for liability reasons. But you could write a little note that said, I visually reconciled that this receipt is associated with the card that I visually examined. The resident let me see the card, and I put 2 and 2 together and reconciled them. You can go ahead and notate that on the file, but if you do make a copy of the full card, I would black out and redact out the account number so that you don't have access to a full account number on a credit card for one of your residents. I like to tell a kind of a funny story that this actually happened to me. I was up in New York City doing some research for a senior property, and I noticed that everyone had $23.23 on their Direct Express debit card. And what had happened is the residents knew that the managers were asking for the receipts from ATMs for the Direct Express debit cards. So the pool of friends that all had their Direct Express debit card all went and got their ATM balances, and whoever had the lowest balance just went and got several copies of their receipt and gave it out to their friends. And so that was a kind of a real life lesson that reinforces the need for you to make that reconciliation between the receipt and the credit card itself. Otherwise, there's no way to associate that receipt with that person. So, you know, don't be tricked by a resident who's giving you someone else's ATM receipt there. Okay. This is the only guidance that HUD has given in writing in terms of how to deal with the debit cards. So you all have to decide what's your policy going to be on all of these other types of debit cards that are coming from these other agencies. You're going to have to be consistent, but I think you're safe either way, either treating them like a savings account and getting that single balance, or treating them as a checking account and asking the resident to give you the statements. A lot of residents will say, I don't get a statement anymore. They can get the statement. They just may not want to do that. So in the absence of direct regulations from HUD, a lot of owners are saying all of the debit cards, we're just going to treat them as savings accounts right now and display the current balance on the 5/9. But don't just ignore these other types of debit cards because this is considered an asset. Okay, so I've got a couple of questions that have come in. One participant has asked, and I think this was in reference to the checking account, what if the person on the account are just on that account for emergencies only? Again, I would argue that if you can verify that they have limited access to funds, and that's been verified by the financial institution, I think you can make a judgment call there. But if it's just the family is telling you that they have access to the account for emergency, but the financial institution says they have full withdrawal rights, I think you need to list it as a joint account. A second question I got is, do we count SNAP for seniors when they only get food stamps but no cash? No, SNAP benefits or any type of food stamp benefit is not considered income, and that portion of their balance on their card is not considered an asset. So you act like you don't even see the SNAP benefit, but you would count the TANF benefit if it comes on the same card. Okay, hopefully I've addressed all of the questions that have come up so far. So we're going to keep going. Anybody have questions on the EBT cards? Okay. Next, we're going to talk about trust. You're not going to see trusts very often, and they're very wordy. They're written by attorneys, so they have a lot of legal jargon in the document. But the take-home message that I want you to remember on trusts is they can be revocable, which means the person who's ponying up the money can change their mind, or they can be non-revocable, which means whoever gave the money to the beneficiary can't ever take it back. So once you've determined whether something is revocable or non-revocable, let's say you've got a revocable trust where the creator is the person that had the money, the beneficiary is who receives the money. Depending on which of those individuals is your resident, if the tenant is the one that created the money or the beneficiary is your resident, it counts as an asset because both of them would have access to the account. Conversely, if you have a non-revocable trust, meaning this person's allocated money to this person and they can't change their mind, if your tenant is the creator, it is not an asset. If your tenant is the beneficiary, it does count as an asset. And again, you're not going to come across trusts that often. You don't have to keep this in your permanent library in your brain and remember it from memory. That's why you have a handbook. So when in doubt, don't be afraid to go back and reference this paragraph 57G1 that talks about trusts, and you go back and you reread the regulation as it presents itself to you in the recertification process, because you're not going to see these very often. Annuities are very hard to explain. They are products that are usually sold by insurance companies that guarantee the individual that bought it to have some regular forms of payments coming back to them when they retire. If they have the ability to withdraw from it, you count it as an asset. But if they can't touch it yet, it is not considered an asset. If they have no option to withdraw. And some of these are just questions you ask the company that sold the annuity. You say, does this individual have an option to withdraw it? Yes or no? That's going to determine whether it's an asset. Then when you have different types of annuities, some of them are riskier than others. So if you have a fixed annuity, that's a low risk type of investment, and they guarantee a set payment amount once the payments start coming in. Variable carries a higher risk. It's the payment that the individual receives is dictated by whether or not the account is earning money or losing money based on how it is reinvested. Hybrids have a blend of the two. Sometimes you have something that's called a deferred annuity, where they don't start paying out until the holder decides that they want to start receiving payments. And then we have ones that are called life category annuities, and those continue to get paid if the owner is alive, and sometimes they have two people listed, and the survivor might get the benefit of both individuals if it was on what's called a joint life. So maybe the wife passes away and the husband continues to get the income for two. These are pretty complex. I don't think I could explain them to you beyond the content of this screen, but it's never prevented me from being able to do my calculations right. Again, it's always okay to call the financial institution. Those people understand it a lot more than any of us. And if we just pose some specific questions and document the answers, we can get the bare minimum details that we need from that account in order to do our calculation. There is a very unique rule with what we call retirement accounts that I want to make sure we're taking a little bit of time on. First, I got a question from Marianne. She asks, if the resident is taking a monthly payment from the annuity, do we only count it as income and then the balance is not counted as an asset? If they are taking monthly payments, it's actually going to be asset income, Marianne. So you are going to include the balance as an asset, and then you're going to be adding the monthly income into the calculation. So you're going to list it as asset income. But that's an interesting segue into the screen that's on the page right now, and it's a unique rule that's kind of like what you were posing. If you have a retirement account and it is not an annuity and it is not a 401k, it only counts as an asset as long as the tenant's not withdrawing funds. Okay. You're still going to withdraw, you're still going to back out any penalties that they have if they were to liquidate it. But those only count as assets if the tenant is not taking any money out of it. And we're going to go through a scenario that illustrates this concept in just a minute. The last part of assets that, again, we don't see very often are things that are called lump sum receipts, which are, you know, just like random large payments that you get as a result of a unique transaction, mortgages, or deeds of trust. So sometimes you might have, like, you inherit a bunch of money from someone when they pass away. That's considered a lump sum. Or you might get an insurance settlement. That's considered a lump sum, and it's an asset. But it's only an asset until it is spent. Okay. Keep in mind, assets are only assets as long as they're still in the account. If you've got $5,000 in your checking account, it's an asset. But if you go and buy $5,000 worth of clothes, that's not a disposed of asset, and it's no longer there. It's no longer listed as an asset. So these are only things that you need to worry about until they're spent. If you have a resident that actually holds a mortgage and they owner finance, the cash value on that particular type of mortgage is just the unpaid principal. Again, you're not going to encounter these very often, so you do not have to have these rules memorized. It's just kind of not the best use of your brain space if you're not going to need to utilize it on a regular basis. Okay. So we've gone over what the different types of assets are. Those were all current assets. A second category of assets are what we call divested or disposed of assets. So many of you, I hope, are familiar with a form or a question that's incorporated into the move-in process and the annual process, where you have to ask the resident, have you disposed of any assets for less than fair market value within the last 2 years? Those are disposed of assets. And when someone disposes of an asset or divests their asset, really what that means is that they gave it away or they sold it for at least $1,000 less than what it was worth. So that $1,000 threshold is something important. I want you guys to remember that. And when somebody gives it away or sells it for at least $1,000 less than what it's worth, they have to count it as an asset for 2 years from the date of disposal. All right. You do not count things that you're forced to relinquish or give away if you have like a foreclosure or a divorce or something like that. That is not considered a disposed of asset. But these are oftentimes things where grandma will give her grandkids her money, or will sell their house to their grandchild for, you know, $500 or something when the house is worth a lot more than that. Those are all different examples of divested assets. And you only have to ask about divested assets at move-ins, or when you're doing an IC, an initial certification, or an AR. You do not have to ask about divested assets every time you do an interim. So don't waste that paper or do more than what you need to do. It's not something you need to ask for interim. All right. Any questions on the difference between current assets and divested assets? Okay. When you have a divested asset, remember it counts for 2 years from the date it was disposed of, not 2 years from the date you put it on the 5/9. So you have to be able to document in your file the date that they disposed of or gave away the asset. So just make sure you make that distinction on when that 2-year time frame starts. Okay, here is a real-world example of a divested asset. So we've got Pita Bread sold her home to her granddaughter for $50,000, but the fair market value of her house was actually $75,000. The cash value of the disposed of asset is the difference between what she sold it and what it was worth. Well, that $25,000 is way more than $1,000, which was the threshold, right? So you're going to count that on the 5/9 as a disposed of or divested asset. So disposed and divested mean the same thing. Disposed of or imputed are not synonyms. They do not mean the same thing. And a lot of people incorrectly interchange those two. So divested or disposed of is the same thing. Does everybody understand how I arrived at the $25,000 value as being the cash value of the disposed of asset? Does anybody have any questions on that? Any questions? Check for hands here. Okay, Kim, you got a question? You're unmuted, or now you're self-muted.
Oh, sorry. I might want to wait till you finish because you might answer it, but I do have some questions on that. So let's wait till you're done.
Okay. All right. You stop me at any time if you want to re-ask it. Okay. Do you want to re-ask it before I go into a quiz question?
No.
Nope. Okay. All right. I want everybody to let's apply what we've learned so far on these concepts. Everybody get their calculator out. Don't cheat and just look at what we're doing. If you don't try to do the math, you're never going to know whether you're truly understanding this concept or not, okay? So Anita Mo Money owns a trailer that has a market value of $24,000. If she were to sell it, so she has not sold it, but if hypothetically, if she were to sell it for $20,000, her realtor fees would be 10%, and her closing fees would be $500. So this is all on a hypothetical sale. Right now, she owns this trailer, and you know you're going to have to list it as an asset on her 5-9. How would you calculate the cash value of that trailer, knowing what I've told you here?
First, you would multiply the 10% from the $20,000 that she would for the realtor fees. So you would multiply 10%, and then you would add the closing attorney fees to that, which would be the additional $500. So total realtor fees, including attorney fees, would come out to $2,500.
Okay.
Is that correct? And then you would add that to the $20,000, so that would give you a total of $22,500, and then you would subtract that from the original market value of the home of $24,000.
Let's see if everybody's following what she's saying. Your fair market value minus the cost to sell it is how you're going to get at your cash value, okay? So our fair market value is the $2,400 or the $24,000, right? That's what the trailer is worth, right? But we're going to sell it, but we're not selling it for what it's worth. We're selling it for a slightly lower amount, right? Because you never get totally what your real estate's worth, right? If we sell it for $20,000, you're correct. The closing or the 10% realtor fees are $2,000. That's 10%, right? And then you back out the $500 in fees. So the cash value of the trailer that you would list on the 5-9 is $21,500. 90% of the industry is going to put $24,000 on that 5-9, and it's going to be wrong. Okay. Does everyone see how we arrived at the $21,500 as the cash value of her current asset? Anybody have any questions on how we did that math?
I have a quick question on the closing percentage.
Yes.
Is it typically 10% or does it vary depending on your area?
It varies depending on your area, but 10% is actually a really good realtor fee. Like where I live, it's 3.5 for the buyer's realtor and 3.5 for the seller's realtor for a total of 7. So it is going to vary by the area. I probably just randomly put that one in there just to see if you would know to take 10% of the selling cost versus 10% of the market value. That's what I was testing. A lot of people take 10% of $24,000. Well, no, it's 10% of what she sold it for. But you guys did it right. Does that answer your question?
Yes, ma'am.
Okay. Anybody have any other questions about this example? Okay. Let's go to our next one. On June 1st of 2017, Be Kind donated $1,300 to her church, and on that same day, she also gave $500 to various charities. Her annuals are in May of each year. Does she have a divested asset? And if yes, how much is it for? Think about what makes a an asset divested? What was the two things that could happen to make it be considered divested? It's either given away or it's sold for at least $1,000 less than what it's worth. So do we have a divested asset here?
Would it be 800?
Well, she's donating 1,300. That's gone. That's to her church. And on the same day, 500. So how much would you guys consider she's divested on that day? How much is she given away?
1,800.
1,800, right?
Yes.
Yes.
So the full amount of her divested asset is 1,800. And she did this on June 1st of 2016. Her annuals are in May of every year. So let's assume she's already done her May 2016 annual. So based on that divestiture date, which annuals are you going to include the divested asset on?
2017.
And
Just you do it with her May when you started to do her May AR, but I'm not sure of what else you need from that.
so
But to do
remember,
an IR,
no, you do not have to do an IR, but it's 2 years from the date of divestiture. So her date of divestiture is June 1st of 16. So it's going to be every AR you do until June 1st of 2018.
So 2017, 2018.
Right. You're going to include it as a divested asset on the May 16. I'm sorry, this should say May 17. I got to fix that or it'll drive me crazy. Hold on. This is going to be on the 17 and the 18 AR. Does everybody understand why?
Because it's for 2 years.
For 2 years from this June 1/16 date. Okay. Any questions on that?
I guess my question is, this money's being donated. What's it being donated from? Her checking, her savings? I guess I'm not.
It doesn't really matter. It doesn't really matter. I mean, she's probably going to tell you, I wrote a check or, you know, I gave him cash or something, but how you categorize it as divested isn't going to make or break the 5-9. You'll have to pick a category. But you're putting it on there because it's divested.
Yeah, I'm new to
depending on the situation and in the real world, Be Kind would be able to tell you what account she got that money from. Okay.
Okay.
I don't think there's a category in one site or Yardi that just says divested. I think you have to pick the originating account when you're establishing it. All right.
Okay.
Any other
So
questions on divested?
just a question. So we basically have to trust what they're saying in the interview as far as being, you know, getting rid of that asset, because if they gave it out of their checking account and didn't say they divested it, we would have no idea.
Absolutely right.
So we're just trusting.
All divested assets are identified through honesty, unless you see it last year and then suddenly it's gone this year, and that's what they tell you they gave it away. But yeah, you're hinging all of this identification based on them being honest and telling you.
So if you ask where to go and they said I spent it on clothes, you take their word for it, and there's not much you can do it. Okay.
A spent asset is not divested. Yes.
Okay.
Right. So Debbie asked the question, if she makes $100 in tithing each month to her church, do we use $1,200 for a year, and what date do we use as divested? Well, if they're continuing to tithe, that's going to be a divested asset that continues to show on the 5-9. So if they were to ever stop tithing, you would have a 2-year time frame to work with. But if they continuously give it the collection and tithe on a regular basis, that's a divested asset that just remains on the 5-9 indefinitely. Okay.
Oh,
All right. All right. So it's important when you are interviewing your residents, whether they're just coming in on a move-in or if they are an existing household with you, they're going to be apprehensive about telling you about their assets, because they, just like, you know, Joe Smith on the street, is going to think that they play more of a role in the calculations than what they really do. So if you can reiterate to them that they actually have a very minimal impact on adjusting their rent, because it's, again, it's not the value of the asset that plays a role in the calculation. It's the income that those assets are earning. And most people's checking accounts are earning, like, you know, 0.1% interest or 1% interest. It's not a gross amount of money that's significantly adding to their overall income. And if you can kind of reassure them that it has a minimal impact, they're more likely to tell you about these assets than they would if they thought that it was going to make their rent jump up considerably. Okay. You do need to be intuitive and pay attention to what your residents are saying to you during the interview process and what they're giving you as forms of payment. So don't be that manager that accepts rent checks month after month after month from Ms. Smith and then allows Ms. Smith to tell you she doesn't have a checking account. Okay. You guys have to put things together. Now, obviously, if somebody is always bringing you money orders, then maybe they legitimately don't have a checking account. But it's a huge red flag for an auditor to go in and do a management review at a property where none of the residents have assets, but everybody's paying their rent on a personal check. Okay, so make those connections with what the resident might accidentally be disclosing to you that may conflict with how they're answering their application or how they're answering their research questionnaire. Okay. Here is an example of the minimal impact that significant asset balances might actually have on an individual's income. So let's say an applicant has a savings account with $120,000 in the balance. Well, normal, you know, citizens that don't work in the world of affordable housing would say, well, if they got $120,000, they shouldn't be living in subsidized housing. And, you know, that may be, you know, a viewpoint that a lot of people have, but mathematically, according to the regulations, because that account is only earning 0.04% interest, what's actually incorporated into the rent calculations is not the $120,000, it's the whopping $48 a year that interest is earning. Okay, so we can have properties with residents with several hundreds of thousands of dollars in assets, and they can still qualify for subsidized housing because their income is only based on interest on those and their Social Security check, you know. So again, when you're doing this type of actual income calculation, we're spoiled because a lot of times the software does it for us, but you can see how we arrived at the $48 was we took 0.04% of 120 and arrived at that actual income of $48. Everybody get that? Everybody seeing what I'm trying to represent there?
Yes.
So Carol says on the real estate example, why is the market value not 20,000? So that's the Anita Mo money with the trailer. Is that the one you're talking about, Carol? I guess what I'm wanting to make sure you understand is that the market value for something and what you sell it for might not be the same thing, because you might be desperate to unload it and you might not get the full value. You know, if you need to sell your house super quick because you've got to move in 2 weeks, you might have a market value of 200,000, but you might be willing to sell it for 180 just to sell it quicker. So selling value and market value do not have to be the same. But if that doesn't answer your question, Carol, let me know and I can try and readdress that with you. Let me see if you're muted. Does that answer it, Carol? You're unmuted now. Oh, she might have stepped away. Okay, I'll come back to that. Okay. Let's go into the second portion of this concept, and that is now we're familiar with establishing what an asset is and how you arrive at the cash value, market value less the cost to convert. Okay. Well, now within those asset categories, you can have actual income, which is the legitimate income that's earned either as like rental income or income from an interest rate. That's what we call actual income. And those are fairly simple calculations where you just calculate the percentage that whatever interest rate the account has, or however much rent maybe the real estate is earning, et cetera, et cetera. So that's a pretty basic concept that I think everybody earns, or that everybody understands. When you have a series of different types of assets that in sum, or when you total all of the asset cash values up together, if it equals 5,000 or more, then you're going to do what's called imputed income. And that is where you take the full balance of the cash values of all of the assets and you multiply it by the passbook rate for HUD. Okay. And for several years, the HUD passbook rate was at 2%, which was really inflated, because I don't know about you, but I didn't have any financial accounts that were earning 2%. They've adjusted that down to 0.06%. And again, your software does this for you. So anytime you have assets that total more than 5,000, when they're all listed together, your software is automatically going to do an imputed income calculation by multiplying that by 0.06%. Just be aware that 0.06%, if you're going to do this math by hand, is 0.0006. Okay, so there's going to be 3 leading zeros if you want to do the math manually on that. Okay, the rule is when you have actual income and imputed income, the 5/9 is always going to take the higher of and include that in your rental calculations. Again, we're spoiled by software that does this all behind the scenes for us. So as long as we get the cash value input right into the software, all of the other resulting calculations are going to be correct on imputed income, because your software is doing the thinking. You don't even have to think about it. Okay. Any questions on the difference between actual income and imputed income? Okay. There is a very, very, very unique rule for retirement accounts where it can actually flip from an asset to an income source. And this is specifically for retirement accounts that are not 401ks and are not, I think they're listed as not IRAs. And they're not annuities. But let's say someone's got a retirement account and they've just been putting money into it for years and years and years, and they've never taken any money out of that retirement account. You would list that retirement account as what on the 5-9? If all they've done is dump money into it, is that an asset on the 5-9? Yes or no? All of you guys are
Yes.
muted. I can't hear you saying it. Yes. Okay.
Yes.
All right. So as long as they're pumping money into it, it is considered an asset. All right. And then as soon as they retire and they start drawing what we call periodic payments from that account, Change 4 of the handbook made a new rule, and it said as soon as you start seeing periodic payments, it flips from an asset to an income source. So what's a periodic payment?
One that
How would
comes
you guys?
every month?
It could be every month. It could be every quarter. It could be a required annual distribution for someone who just turned 70 and a half, and it happens every year. So keep in mind, a periodic payment is a predictable schedule on when the next payment will occur based on a pattern that you've seen, okay? So it could be weekly, it could be monthly, it could be quarterly, it could be every 6 months, it could be every year. Based on what you've seen, it's a predictable schedule. And when you see those periodic payments come in through that predictable schedule, that becomes an income source and you remove it from the 5-9. All right. So if it's a sporadic withdrawal that's random and you don't anticipate when it would occur again, that is not considered a periodic payment. All right. You're never going to know if an asset needs to flip from an asset to an income source unless you specifically ask on your paperwork, are you getting periodic payments from a retirement account? So you need to make sure that that is on your paperwork. Carol, that is a question that's on the application and research questionnaire you guys are going to be pushing out. All right. So here, let's take an example of this. Let's pretend, Debbie, I'm going to pick on you. So Debbie has been working for years and years, and she's got $400,000 in a retirement account. And she has given her notice and has decided that she is going to retire. So historically, that $400,000 has been listed as an asset on her 5-9. Well, she's retired, and then that first month she takes $400 out of it for her living expenses. And the next month she takes $400 out of it for her living expenses. And the next month you see $400 come out. We've now established a pattern of periodic payments on a monthly basis of $400. All right. What is going to be displayed on Debbie's 5-9 now, based on what we know is happening with that retirement account? She's got 400. So how much in income?
400 a month.
400 a month, which is 4,800 a year, right? And what are we going to do with that remaining balance that's left in that account, which is over $300,000?
Wouldn't it still be an asset?
No, not anymore.
Because
That's what we would think intuitively. That's what common sense would tell us. But no, with this new handbook change, it says as soon as you see those periodic payments, the balance of the account is no longer considered an asset. that $400 just got scratched from that asset account, and all that's showing on the 5/9 now is the $4,800 in income that she's getting from periodic payments. Watch out for that, guys, because you've definitely got some folks that are getting retirement accounts. You need to be finding out and asking those questions during the interview whether or not they're taking periodic payments. Okay? Any questions on that unique rule for retirement accounts?
So the quiz question number 2, is that just like what we did? And so the answer would be 600, answer B in 600?
On what page?
Page 8.
Yes.
Okay.
We're going to go through that quiz here now.
Oh, okay.
Okay. Okay. So you were on the right track. Okay, so Johnny Depp has been compiling money in his retirement account for over 40 years to fund his retirement. The balance is $400,000 and earns 0.05% interest per month. Johnny has reported this account as an asset on his prior certs. Last month, Johnny retired and has started taking $600 monthly from his retirement account to cover basic living expenses, and his annual's coming up in 3 months. So how would you list this? What was your answer?
Only as income at $600 a month for 12 months.
Correct. $7,200 in income, no mention of it on the asset section at all. Whoops. Okay. So we're at $7,200, and the rest of that remaining balance, even though it's, you know, $393,000, it drops off of the asset section entirely. What happened to his asset? What happened to his asset income now on his 5/9?
Dropped by 7.
It dropped, right? Because we were doing imputed income at that amount, right? Because he had more than 5,000. That imputed income is gone now. Okay. So the answer is B, an income source with an annual income of $7,200, and that's it.
So a quick question. If auditor is looking through the file and sees that we dropped off over $300,000 from an asset, should we clarify it, or is that something that they will know?
It's something they should know, but if they don't, I would point them to that reference that I give you at the top of page 8.
Okay.
You can always clarify something your MOR reviewer may not know when you point to the regulation. And it's better to do it when they're looking at the file than having to justify it because they erroneously gave you a finding for it. Show them what you know on the date of that MOR. Okay? All right. So here's probably the most complex example that you could ever really have to deal with on an asset. Okay? Josie Dangerfield is applying to live at your property, and she holds a fixed annuity that is not for retirement, for which she will not receive payments on for another 3 years. Okay. The current value is $17,589, and it's earning interest at a rate of 4.5%. She can withdraw the current balance, but she'd pay a surrender penalty of $3,000, and she would owe tax penalties on it as well. All right. So here I've shown you the math that this is what people get hung up on. They look at the current value of $17,589, and they throw that on the 5/9 as the cash value, and that's not the cash value. Okay. The actual income that it's earning is market times its percentage rate, right? So I show you to calculate the actual income you do the 17,589 times 4.5%. I don't know why that period shouldn't be there. Right there. Does everybody see how I come up with the actual income? Actual income is market amount times the percentage, the interest rate. Everybody good there?
Yes.
Okay. Imputed income is calculated by taking the cash value, not the market value. And when you impute, you always use the HUD passbook rate. So you can't go straight from 17,589 and multiply it by a passbook rate. First, you have to establish its actual cash value. Cash value, remember, is market value less the cost to convert. So we take our 17,589 and we back out our surrender penalty of 3,000, and then we back out our 1102 in tax penalties. What do you guys get when you subtract 3,000 and 1102 from this 17,589?
13,487.
Okay, that's where I'm getting the cash value. That's the cash value of the asset. That's the amount that's actually going to be listed on your 5.9. Because that's more than 5,000, your software is automatically going to impute it using the passbook rate of 0.06%.
$8.09.
Right. But now your software is going to know we're going to take the greater of the actual income of $791.50. Now it's going to round up, right? Because you don't show cents on a 5.9, so it's going to show $792 as your actual income and $8 as your imputed income. It's going to take the higher of those two, and that's going to be your asset income for this type of fixed annuity. Okay. Everybody clear on that example once you see it written out like that?
Yes, ma'am.
Anybody have questions on that? See if I have any new hands showing up. I don't see any other questions on the questions box either, so I'm going to assume everybody's okay. This is the most complex of the examples you're going to have to encounter probably on a semi-regular basis at a senior property.
I do have a question.
Okay, go ahead.
I'm new to the industry, so this is all
Swahili?
Yeah, it's still boiling around in my brain. But so basically, though, they are going to take that larger amount will show as income on their AR until if they're not collecting it. This is what's going to show on the 5.9 is the actual cash value, which is the market value less the cost to convert. So it's going to show the value of the asset is 13,487. And what's your the portion of this that's important is that the 5.9 needs to know how much income is this asset earning. Mm-hmm.
And we know it's earning $792 a year in income because it's got a good APR, an interest rate. But because this is also more than 5,000, it's going to do a comparison calculation by imputing the income using the passbook rate, and you get a much lower value. It knows to display the higher of these two values. So it's going to show that Josie Dangerfield has an annuity with a cash value of $13,487 with an asset income of $792.
Okay, so I guess my question is, being new, how is that going to affect their rent? Is it going to affect it since they're not collecting?
Yes, because she's earning income on it. So what's incorporated into the rental calculation, whatever her income is that's showing on the left side of the 5.9,
Okay,
your computer is going to your software is going to add $792 to that
so that'll
before it,
come up on the income side then.
yes, this
Okay,
gets incorporated into the annual income amount before you reduce it by any deductions or expenses.
okay, that's what because I haven't
Okay.
done anything like that, so I just
Yeah.
was.
Yeah, which has a much less significant impact on rent than what the cash value of the asset is. See how that's representative? It's not, they're not taking a $13,000 hit on their income and making it look like they've got $13,487 to spend on rent. It's only utilizing the income that asset is earning.
Okay.
Okay? Okay. All right. This is the final scenario that I want you guys to look at, and this is an exercise that is going to incorporate multiple concepts that we've talked about in today's webinar, and I want to see how much you guys are picking up on what is made available to you during an interview process, okay? So John Jones is a single applicant that's at the top of your waiting list, and you're trying to gather everything you need to go ahead and finalize his move-in. And on a previous interview appointment that he had with you, he had given you 5 statements for his checking account. All right. And I've shown you here on the screen, and it's displayed on page 9 of your materials, what those ending balances were on his prior 5 statements. Okay, so you know you're waiting on that 6th statement to do your calculations. On his application, he told you, I work full-time at an elementary school. I have a checking account at First Bank, and he hasn't disposed of any assets. Okay, so it's May 1st of 2017, and he's finally brought in that last checking account statement that you needed to complete the calculations. And this is what he's brought you. Now, let's pretend that it is Friday afternoon, and it is 4:45 in the afternoon, and you've had a hellacious week. You can't wait for it to be 5 o'clock to start your weekend. The tendency is for you guys to go straight down to this end of this last statement, capture that balance of $598.60, and run with it with your average 6-month balance. Figure out what his checking account cash value should be, right? I mean, that's the reality. We are tired. It's Friday. Boom, there's my ending statement. That's the last thing I needed to calculate my average 6-month balance, and then I'm out of here. But if you stop and look at what this statement's telling you, I want to see what you guys are picking up. Based on everything that I've given you in that scenario, how are you guys going to proceed?
The savings account.
All right, so we're looking at the detail. We're seeing what it's telling us. You see, we've got a web transfer from a savings account that was not previously disclosed, right? So we've got an additional asset now that needs to be added. What else have you guys discovered?
He works at the DoubleTree.
He works at the DoubleTree.
Yeah.
Because you're seeing payroll deposits, right? So previously he told you he worked at the school, right?
Right.
So we've got some income from DoubleTree. Okay.
He also donates weekly to a church.
Is that significant to us?
Would that be a disposable asset?
calculate it and see if it hits your threshold.
Okay, so that would be no. Yeah, let me think. 20, can't remember what the threshold is.
1,000.
Your threshold is 1,000.
1,000 or more.
So he's donating $20 a month. He's tithing, right?
Yeah, it's more like $20 a week. So that would be
I'm
80.
sorry, $20 a week. Yes.
Yeah,
So
so it'd be
what's 20 times 52?
1,040.
Yeah. So you would need to do that.
Just over the threshold. So yes, we have a divested asset. So as long as he continues to tithe, you are going to always list the 1040 as a divested asset, right? All right, so we've got a savings account, some extra income, some tithing. What else?
You have an Interact refund?
Yeah, we've got a refund, but that's like, it's
Oh, no.
$2.99.
Regular refund, yeah.
What else? Something else that you guys haven't mentioned. It could have multiple impacts.
It's a joint account.
Oh, it's
Okay.
a joint account. Who else is on the account?
Martha.
So what would be some follow-up questions you would have for John about Martha?
Who is she?
Does she live with you?
Does she work at DoubleTree? Right? Maybe it's not John that's working at DoubleTree. Maybe it's Martha that's working at DoubleTree. We definitely have a joint account, right? So depending on whether Martha lives in or outside of his unit is going to dictate whether we prorate the balance. If she's there in the unit, then we prorate, or we wouldn't need to prorate the balance. But now we're doing a whole bunch of paperwork on Martha because he applied as if he was a single occupant, right? So you've got some catch-up work to do to qualify Martha. Maybe she's the one that's working at DoubleTree. You're going to have to now do income verification on her. If Martha doesn't live in the unit, then you wouldn't include the income that's being earned by DoubleTree on his 5/9, but you would still take 50% of this 6-month average balance for the joint account, right? So you have to take the time to look at what is presented to you in documentation that may not have been what you were originally looking for when you asked for the document, okay? So we've got a joint account, potentially another occupant, another income source, an undisclosed savings account, and tithing, all things that we picked up by just looking at one checking account statement. This again reinforces why it's so much better to look for full statements as opposed to just getting an average 6-month balance from a financial institution on a single verification form. Right?
Yes.
All right, so did you guys pass that test? Or would you have been that one that at 4:45 on a Friday went straight to 598.60 and calculated your average 6-month balance? Silence on the phone. Okay. I want to end with just a couple of things I want you guys to put in your back pocket and be prepared for new regulations that are going to come out that are going to drastically impact how you deal with assets. They're not on the street right now, but they will be hitting the street probably next year, and it's going to have significant procedural impacts for you. So it's a new act that we call HOTMA, and you're going to hear more and more about HOTMA as the time gets closer. But basically, HOTMA was an act that indicated that there were some new regulations on assets, but in order to make these go into effect they had to start, like the go live date has to be January 1st of a year. So because they couldn't get rulemaking in place by January 1st of 2018, the next possible date that this could go into effect is January 1st of 2019. And this is the impact. It's basically saying with this new HOTMA Act is if you have applicants or current residents that have assets that are more than $100,000 in net assets, they would be ineligible for assistance. So this is where we're kind of going back to the taxpayers' opinion that if somebody's got a whole bunch in assets, then why are they taking up a unit in subsidized housing when they could really afford a market unit somewhere else and make that inventory available to someone who's truly low income. So this is impacting, again, not only applicants, but current residents. So if you had a significant amount of assets of more than 100,000, you might get your assistance terminated. Doesn't necessarily mean their tenancy would be terminated. It just says that they would no longer be eligible to receive assistance and they'd have to pay market rent. It also said that if they had a what we call a present ownership interest in a suitable home that for all intents purposes they could be using to live in, that they would be ineligible. Now it gives some exceptions here. So it says, we understand, you know, we might have an 83-year-old woman that owns a home, but if she's got mobility restrictions and it's a 2-story with the you know, the bedroom upstairs and the bathroom downstairs, you know, that it's not feasible for her. You could also say that maybe the person who's leaving that home that's available to them is a VAWA victim, or that they're trying to sell the home. You know, so there are some exceptions that would be allowed, but it's trying to say, hey, if you've got a house and you can afford to pay for it, don't take up a Section 8 unit for someone who really needs it. Now, when this first came out, owners and agents got real hot about it because they thought, you know, this is unfair to the senior population that's living in assisted housing, and that this is a pretty drastic change. Well, when they put out some guidance on this, they said owners have an option to not enforce this limitation at all. So that right there made it a voluntary procedural change. They established exceptions, and they said if you wanted to put it in place but maybe delay implementation of it for 6 months, you could do that as well. So generally speaking, this wasn't very well received by industry stakeholders that advocate for senior housing. And so a lot of those stakeholders are probably going to consider this a voluntary practice and not implement it. But it's a mechanism that HUD thinks will make more of the inventory available to low-income households that truly need it. So those seniors that just get their Social Security check and can barely make ends meet, not necessarily grandma who's got $400,000 in retirement accounts. So that can be somewhat of a political discussion there, but just know that is coming down the pike and will probably go live sometime in 2019. It also said that right now our threshold to impute is $5,000. This act would jump that threshold up to $50,000, which, you know, that's good news for individuals. A lot of it's not going to apply to a lot of our households that don't have that much in assets, but sets a higher threshold for imputing from $5,000 to $50,000. All right. What else? I can't think there's anything else with HOTMA that would impact you guys on the asset category. Does anybody have any questions for me on assets, or just general comments? Do you guys feel a little less intimidated by assets now that you know the equations or the rules of taking market value less cost to convert to get cash value, and then understanding the difference between current asset income and imputed asset income, and the difference between current assets and divested or disposed of assets? Anybody have any questions, or you guys glazed over and ready to talk about something different? A little bit of both.
I have a question based on a move-in I tried to do when I very first started working here.
Okay.
And it's not a specific question. I'm just wondering how it should work out, I guess, or whatever. I had a woman apply, and she had given a house to a granddaughter or a daughter whose granddaughter was living in it or something. So she told me what it was. She didn't try to hide it or anything on the disposable asset thing, but then she did not have a date of when it was disposed of. She couldn't get any information from it whatsoever. So how would you proceed? And she ended up just dropping it because she couldn't find the information, although I'm sure it was out there. How would you proceed with that?
Well, if she truly gave, it kind of depends on the records that would be available. If she owned that house outright, then there would be no record of an ownership change with a mortgage company. So it could be, if she owned it outright and she wasn't paying any principal on it, it could be that she would just have to come up with a date that she thought was, you know, on or about the date that she decided to give it to the granddaughter. In the absence of, of her having, that would be kind of a last resort, is, well, come up with something that you think is, generally correct. Otherwise, I would try to refer back to some type of documentation that would support that transaction, like, maybe the property tax office would get the new name of the owner of the property for property tax purposes, and what date that showed as a change from the grandmother to the granddaughter. But I mean, I would say I wouldn't just let her drop it and not put it on there.
Right.
A good guess is better than not displaying it at all. So it might be that maybe the granddaughter has to kind of help her decide when she thinks that they did it. Was it in, the summer of 2016 or something? If you're putting June versus July, it's not going to make a huge deal as long as it doesn't conflict with any documents. But if you don't have anything, I would think an educated guess is better than nothing.
Okay, so we could have proceeded with it with that guess if necessary. I asked her if she could go back and get some property tax value on it or something, but she just didn't go forward with it and end up dropping her application. So a person.
So she never moved in at all.
She never moved in because she didn't want to come up with any information.
Oh, well, that's her prerogative.
Right.
I mean, so technically, if she were to come back and say, okay, well, I'll give you this, then, I would reprocess her application.
So basically, I could do that reprocess. So and I'm wondering if the case may be that she didn't actually officially transfer it, would she still just be claiming it as an asset then? And if she did claim it as an asset and was not getting any rent on it, how does, that's my question. How does that work?
Okay. So if someone owns a house, let's say they own it outright, they have no mortgage on it, they do not have anybody renting it, so they have no rental income. I get a lot of people that say, well, how do I know how to calculate the cash value? There are multiple websites out there or real estate entities all across any kind of metropolitan area Well, they will go to a house and do a market value study for them, and they're free. Most realtors don't charge for that because they want you to consider them as the listing agent if you ever want to sell it. And so they'll give you an estimated market value. And then you can use those same websites or that same realtor as kind of as a comparable example of what type of closing costs would be associated with whatever you came up with as the market value. You know, whether it's a set realtor fee on closings in that particular city or county, and what type of, you know, other fees would be associated with selling it, that same realtor can give you those estimates. So if you use those estimates, whether it's from a realtor or from one of those real estate websites that does those estimated calculations for you, you can print that out and put it in the file to substantiate, okay, here was our market value. This is what the realtor said would be the standard costs associated with selling the property at that price. And you would deduct those to arrive at your cash value. That makes sense?
Okay. Yeah, that actually helps. Thank you.
Yeah, sure. Anybody else have any kinds of asset questions?
But if you have an appraisal value, couldn't you just use that?
If you have a what?
An appraisal value?
Yes.
Like from the tax office?
Yes, an appraisal value would work as well. Yeah.
So say the house is worth $100,000 once you got all everything, the cash value was $100,000, and you put that in, how is that going to affect their rent? Is that just going to be as an asset then? It's not really going to affect their rent because there's no income from it?
Well, so you're saying the cash value is $100,000?
Yeah, just, you know, as a ballpark figure, just for an idea.
Okay. So there's not going to be any actual income because it's not being rented, right?
Right.
But it's going to get imputed income because it's over 5,000.
Right. Okay. So then you
so
do
the imputed income is going to be that 0.0006 times 100,000, and that imputed income will be in the rental calculations as added to the income from the annual income.
So $60-ish?
Whenever, I don't have my, let's see, I don't
Yeah,
have
well,
my,
I just ran 100,000 times 0.0006, so that'd be $60 per year then.
yes.
Okay,
yeah.
So just to clarify, so like I said with my situation where if the granddaughter was living in a house that she owned but she wasn't charging her interest, this is still the way we would process that?
If the granddaughter was living in the home and the grandmother was not charging her any rent,
right?
Yes, then it is still an asset owned by the grandmother.
Okay,
yes,
so it's
calculation
still process
would just be that imputed income. Yes.
Okay, that helps. Thank you.
Sure. What else do you guys have? Anything for me? We've got a couple of minutes before we end. Anybody got anything?
Let me look at my notes.
In the meantime, I'm checking to see when our next session is.
I believe February 8th.
Just confirm that on my calendar here. Yes, February 8th from 11 to 1 is going to be our next session, and that is going to be fundamentals of calculating annual income. So we'll talk about all the different ways you calculate income from different types of sources. All right. If anybody has any burning questions between now and then, here is my contact information. You are welcome to send me follow-up questions or give me a call and ask me questions related to the topics that we've covered thus far. If it's a topic that we're about to cover, I'll probably tell you that, but I'm happy to field questions that may come up after these sessions. So feel free to use my email or my phone. That's my direct line there. Anything else for the good of the group before we sign off?
So is there a spot we can download this slideshow? Or is, because your last slide has your information on it?
Let's see. I can give the slideshow to Carol, or I could email it out to, I can email this out to the group.
Well, most of the information's on your handouts, just not your contact information. So that's all we really
Yeah,
need.
no, I can email the contact info to the group. That's not a problem. Sure.
Great.
Sure. All right. In the absence of any other questions, I'll let you guys go. Thank you for your participation. I hope you found it helpful and applicable to what you guys are doing every day at the site. And I will talk to you in early February about calculating income.
Thank you.
Thanks, guys. Bye-bye.
Sweet. That was awesome.